Before we jump into it, if you haven't subscribed down below, go ahead and do that and like this video for the YouTube algorithm. I noticed most of you aren't subscribed yet, so go ahead and flip that for me by going from unsubscribed to subscribed. Hit that like button, hit that sub button, and let's jump into it. So let's open up the big lens here. I don't know why I'm talking like that. Let's open up the big lens here. Let's talk about how to fund your business. There are a few different ways that you can do it. The first is credit card. Credit cards are something that we all have access to, and it's something that early on in my business career, I used a lot of. I had access to a decent amount of credit, and so I used that to make hires on Upwork in order to keep our business running before I really had customers. There are some benefits to using credit cards to grow your business. The first is they are very easy to access. Everyone basically in America has a credit card with some kind of limit on it, and all you have to do in order to access it is just spend more on there. They also have a relatively high limit. And I'm talking at least several $1,000s. My limit all in after I applied for a bunch of credit cards planning to do this ended up being around 40K, and I maxed them all out. I got 40K into debt and I blasted it all out in one check. You know, Dave Ramsey talks about the debt snowball. I'd rather do the debt bazooka, get into a bunch of debt, use that money well, and then pay it all back in one big slammer. Of course, it took about 2 years of interest payments before I got the slammer, but that's fine. Relatively high limit and easy to access. The problem with credit cards is they are expensive long term. The interest rates add up to the point where if it takes you too long to pay off your credit card, you might pay double or even triple the amount that you borrow. So if you're borrowing $40,000, you might end up paying $80,000 just because you took so long to pay it with the interest payments. So that's something to keep in mind. And because it's so easy to access, it's also easy to invest in the wrong idea. A credit card isn't like some of these other options. You don't have to get approval to spend on your credit card. You could just go grab your Chase rewards card and just start racking up Upwork billing right now. And you wouldn't have to tell anybody, you could just knock it out. And that is both terrifying and exhilarating at the same time. So it's easy to invest in the wrong idea. So just make sure before you go all in on your credit card investment that you really believe in your business. And those are the pros and cons of using the credit card. I used my credit card to fund my initial business venture. It ended up fine for me. I don't know if it ends up fine for everybody, but everyone I've talked to that has used credit cards to fund their business, it has also worked out for. I think because if you're willing to take the risk, then you work to get the reward. But if you don't want to take so much risk, then another path that you can use to fund your business is startup loans. Startup loans are websites like Pipe, Fundbox, or even Stripe Capital that will give you a loan based on the revenue of your business. So if you make $10,000 a month, you might get approved for $1,000 a month loan, or maybe even bigger, maybe $10,000, $20,000, $30,000 loans based on the revenue of your business. What's cool about these is they are easy to access. Almost anyone with a business bank account can qualify for these. They have a medium interest rate, meaning lower than the 20% that you're gonna get on your credit card. It might be 10%. Still very high, but not as bad as funding on your credit card. The issue with these is they have low limits. For instance, on the Fundbox account, I was only approved for $1,000. That's much different than the Stripe Capital, where you could get approved for a 5, 6, or maybe even 7-figure loan based on the revenue of your business. So depending on where you are as a company, startup loan might be right for you. But if we're talking about funding a business from scratch, you're probably not gonna have access to a startup loan, and you're most likely gonna have to go with the credit card. Or this next option. The next option for funding your business is friends and family. Friends and family is exactly what it sounds like. You're raising money from your friends and your family. This is probably the easiest money and the best rates that you're going to get. Your friends and family aren't going to charge you crazy interest rates, and if you talk to the right people, they do have the money to give you. So for instance, if you have a friend that's making like $250,000 a year, then they can kick you $5,000 for the startup. If you have friends that are multimillionaires, then you might even be able to raise $200,000 per person. You can really stack it up quick if you talk to the right people. The first startup I worked at in New York City was funded entirely from friends and family. The founder had raised about $300,000 from his contacts, from his banking friends, etc. and that funded the entire business. The problem with doing a friends and family round is it has the potential to destroy family relationships. So if you borrow $50,000 from your uncle and then the business fails, good luck talking to your uncle again. Same for your parents. If you borrow $300,000 from your parents and your business goes under, especially if it's due to some stupid reason that's your fault, like you catch depression after borrowing $300,000 and then now your business is going under, like it's going to destroy your family relationship. You're not going to be able to talk to your mom ever again. So you can use that as fuel to work harder, but also know that that anxiety might eat you alive and cause the business failure in itself. Another way to fund your business, if you don't want to do that, is bootstrapping. Bootstrapping means funding a business from the money that the customers bring in. So if you need $1,000, then you need to sell $1,000 worth of product in order to fund that $1,000 expense. The cool thing about bootstrapping is you owe nobody. You're not borrowing money from anybody, so you don't have to worry about the family relationships being burnt. You don't have to worry about interest rates. You don't have to worry about anything like that. You have money. It's your money. You can spend it as you see fit to grow your business. That also means, of course, no interest rate, no repayments, no debt. Beautiful. The problem is it's hard to get right. Meaning, instead of being able to borrow $10,000 and invest it as you see fit, you might have to make do with $200 in revenue. How do you grow your business with $200? I don't know. So you might actually have your business fail because of a $200 expense or a $1,000 expense, which is terrible. How many times in the early days of business did we almost fail over having an extra 500 in the bank account or an extra 1,000 in the bank account, right? So it's very tough if you're only funding your business based on the revenue that comes in, unless you hit it out of the park in month one with a crazy launch. And that goes for long-term growth as well. Growth can be slow. If you only make $1,000, you only have that much to invest in your marketing. And so you can't really get much with $1,000 these days. And so your growth can be slow. And in fact, your startup can be choked to death because if revenue is $1,000 one month and then you invest $1,000 in marketing and it doesn't return the way you think, you might be at zero the next month and your business might be dead. The alternative to bootstrapping and what we do now for our businesses is what we call at A&R Ventures hybrid bootstrapping. Hybrid bootstrapping is using the revenue generated by your other businesses to fund your current business. And this allows you to increase the amount that you can invest to the point that your business can actually be successful. And that doesn't mean using your other businesses to fund this business. That's not the only way it could be. It could also be using your personal net worth, using your salary, using any other means to fund your business. With hybrid bootstrapping, you still owe nobody. There's still no interest rate because you're giving money to the business yourself. And you can choose to pay that back at any rate you want if it succeeds. And instead of being hard to get right, it's easy to get right because you don't have to go through anybody else for approval. It's easy to get approved. It's easy to get right. And instead of growth being slow, growth can be fast. If we realize that we need 30,000 to grow Taplio in the next 30 days, guess what? We'll just put 30,000 in. We don't have to generate 30,000 in revenue to make that happen. We just take the money, we see the opportunity, and we invest in the business. It's beautiful. If you want to learn more about starting a business and join a community of hustlers and creative entrepreneurs that are all growing their companies together, then go ahead and check out email10k.com. It also comes with access to all of our business courses and direct access to me. So if that sounds interesting to you, then go to email10k.com and join today. Thanks for watching the video. Be sure to smash that like button to encourage this type of content on YouTube. Subscribe for more videos like this, and I'll talk to you soon. Thanks for watching. I'm Alex Berman.